Okay, welcome everyone and good afternoon to an educational forum for the first time presented in Philadelphia by Eminae Network. Give us a round of applause. I am Winnie Benjamin, and I'm one of the host speakers today. Well, I'm not a speaker, but the one that will actually welcome each person and, of course, introduce the programs too. All right, so let's talk about, I only have a few seconds on the clock. So I just want, how many people in this room know of Eminae before today? Let's just show our hands. Not a lot. Okay. You find us at eminae.com to get deep dive information. But pretty much we're pretty much about 7 years old. Not a lot. But we have accomplished an awful lot in the New York area, based in Long Island, and of course, the New York City with mixers. We have constant roundtables because it's all about merger and acquisition, education across the board. And that's who we serve will be the CEOs. I'm the co-chair of the CEO, Eminae CEO committee as it pertains to education and the forums. And it gives me great pleasure to serve for the last 7 years or 6 years, but from the inception, I really love it. I benefit a lot from it, and you have to be very, very creative. So it's actually an exclusive educational operation where we celebrate, we educate, and we also celebrate all of the activities and the wins. All right? So what I want to do right now is, number one, I'm hoping that you all would go online, and I'm going to do a shameless plug that you all figure a way to become a member of the Eminae awesome network of trusted advisors. We want to be number one. Okay, we are striving to be number one. And I know that after this experience, you will see the benefit of why you should be part of Eminae. All right, so I don't want to go any longer because we have a really packed program for you today with knowledge, and I just want to bring up the visionary, the founder, the one that aspires and work hard to make sure that the advisors in this industry get to know the market and the market get to know you. And that person is none other than the awesome Carl Griffith!
What an introduction, oh my gosh. I felt like I just won a Super Bowl. Like, what's going on? Well, I want to say welcome to each and every one of you. I mean, look how many faces we have here. Just so remarkable for our first CEO forum in Philly, and the house is just packed. So you guys came out, the weather is nice. Looking forward for some powerful education. We have a lot of folks I want to thank here, but I want to start off by thanking the parties at Witham CPA. We did this event last year in New York City, and the team at Witham, Matthew and Brian, where you guys at? You want to raise your hands? Fabulous. Matthew and Brian came to say, we want to have one of these in Philadelphia as well. So we were here. So I want to thank you guys for coming out. A little bit about Eminae Network. We are a team of advisors that support business owners that are in transition. Most of you guys are deal makers here or service the mergers and acquisitions space. So I wanted to create a platform where we can educate advisors and business owners on all aspects of business sales and acquisitions. And we felt that this topic is very timely based upon the current tax and regulation environment we're in right now, to have a conference on tax planning and all of the aspects of all regulatory concerns that businesses have, especially this time of year. Every panel we have a topic of deal making, so that'll be our second panel, so do stick around. The food is going to be coming out until 6 o'clock, so definitely stick around for that. Let's just kick things off. We have a lot to go over. I want to introduce Martha, Ms. Shredder. She's our rock star, leader of our New Jersey chapter, and also one of the top insurance advisors from Hub International.
No, don't tell him insurance yet. They won't listen.
So Martha's going to introduce our moderator and our panel, and we're going to get this show going. Martha, the floor is all yours.
Thanks, Kyle.
Thank you. Round of applause to Martha.
Awesome. All right, so he already blew up my spot. I am an insurance broker. but please don't stop listening. I'm the good kind. And I love the Eminae network. I actually just joined last year. I'm in New Jersey and New York, and it's been a really great collaborative spirit. So I love being a part of the CEO Forum down here in Philly. As we know, the M&A community, you can't really silo yourself into one state or one area. You have to kind of know what's going on, and these are really relevant topics. So for our first panel that we have, we're going to have a great moderator. Kalima is with KeyBank, and they are absolutely vital to planning your exit strategy, right? Pre, post, close. I'm not going to talk about banking because that's not really my area of expertise. So you can come on up, Kalima, and get ready for our first panel.
Appreciate it. Hello, everyone. Welcome. So I am going to have my panelists come up, and I guess you guys can take your seats wherever you would like to sit. So good afternoon, everyone. I don't want to hit anything here. Did I? Yes, I already did. Martha, you going to come up and fix this? Oh, okay. I hit it again, so there we go. Well, good afternoon, everyone, and welcome to the M&A CEO Forum's Tax Policy and Financial Planning for M&A panel. You can clap for that. Yay! So I am Kalima White, and I am a senior. There you go. Thank you. I am there you go. Nice. I'm a senior consulting director with KeyBank's Business Advisory Services Group. I like to say I'm a recovering attorney hiding out in banks for the past 20 years or so. I say it all the time, so the people who here who know I say it don't tell anyone. And I've had the pleasure of working with closely held business owners to plan their transition out of their business for several of the past 20 years or so. And so, as I'm sure you have noticed, and Martha mentioned, I am your moderator for this dynamic panel of experts on pre-transaction tax and financial planning strategies for successful M&A transactions. And so as a consulting director in the BAS group, and that's what we call our Business Advisory Services group at Key, because bankers love all the acronyms. So at our BAS group, we work routinely with closely held business owners looking to sell their business, and they really have no idea where to start, right? And so, but we normally see a couple of common themes during the sell-side conversations that we have with business owners. One, they would like to maximize their sale proceeds, right? Take as much home as possible net of taxes. That's really the one thing they know they want. The other thing is that they want to continue with the same lifestyle or level up that lifestyle, right? So, regardless of whatever, those are the things that they want to do when they sell their business. So when advising closely held business owners selling a business, we always tell them that they won't meet either of those goals without pre-transaction tax planning, whether that's on the income tax side, the wealth transfer tax side, and also with personal financial planning. And the sooner they connect with the team of experts like we have over here, the better, because their financial outcome will be better and certainly possible for them to save 15 to 30% with advanced tax planning. So we are in luck today. We have a panel of experts who can advise us on these and other topics related to M&A transactions, whether on the sell side or on the buy side. And so I know that they can give a better overview of their expertise than I can, so I will ask each panelist to briefly introduce themselves, and we will start with Scott Patterson.
My name is Scott Patterson. I'm a tax principal at Witham in our National Tax Services Group, specializing in partnerships. My core practice is consulting on all businesses, particularly partnerships, especially M&A transactions. But any complex partnership transaction and restructuring is, I get brought in to help all the clients across the firm. Essentially, I'm a problem solver to help create solutions to minimize tax.
Okay, Hi, my name is Kristen Schmid. I am a shareholder at Colzer and DePadova. I handle basic, corporate tax, as well as M&A transactions, real estate, international tax. I started out my career at PricewaterhouseCoopers, where I was in the M&A and international groups, and there I helped Fortune 500 companies structure globally, as well as I did buyer side due diligence. But now at Colzer & Padova, generally a lot of my clients are not Fortune 500 companies. I help a lot of sellers get ready to sell their practice, as well as buyers come in and identify what's a good fit for them, and help them with the transaction process.
Good afternoon. I'm John Longino. I'm a principal CFO with Pro CFO Partners. We basically are your full-time CFO on a part-time basis is what we do. And I started my career at Arthur Andersen. You guys may still have heard of that firm. I think it was a pretty good firm back then. Got my start in public accounting and did a lot of work with clients in mergers and acquisitions, but was also a business owner since then and a public company CFO and basically a career CFO where I've been involved from the financial side looking at mergers and acquisitions for companies for a lot of years. So hopefully we got something we can help you with.
Hello, everyone. My name is Pambi Katema. I am special counsel at A.Y. Strauss, LLC. I have spent a great deal of my career with law firms. I used to work with a lot of really large transactions when I was with a couple of AmLaw 100 firms. Lately, I've been working with a lot of mid-sized and small companies. I work mostly in the M&A area. I help companies figure out how to acquire or enter into joint ventures and strategic relationships. I also help with entity formation and shareholder and partnership agreements. I have a blended practice of corporate and tax law. So normally in the area of joint ventures, I'm usually a one-stop shop. I handle both sides of the corporate and tax side of the deal. Thank you. That's all I have.
Great, thanks, Pami. Yeah, you can keep that one. I think we have a couple other good ones now. So yes, definitely a powerhouse panel that we have with us today. So let's start off with the changing tax policy and regulatory landscape, right? Which we all can agree will continue to change over the next several years. So Kristen, I'll start off with you. What are the most significant recent changes in tax policies affecting M&A transactions?
So honestly, in the past few years, we haven't seen that much. In 2017, we had the Tax Cuts and Jobs Act, which was the biggest tax reform that we had had since, I think, 1986. And with that, there were a lot of provisions that affect businesses and really a lot of provisions that affect individuals. Since then, we really haven't seen too much in the way of tax except for during the pandemic. There were a lot of provisions that were kind of band-aids to help businesses survive the pandemic. I'm sure a lot of your clients or even potentially your business got a PPP loan or might be waiting for your employee retention credit right now. But since then, the tax world's been kind of quiet. However, the Tax Cuts and Jobs Act, a lot of those provisions expire at the end of this year. And so right now, we don't know what's going to be extended and what will end up expiring. Now, before the election results, there were a lot of concerns by business owners because of both candidates and what their proposals were. So for instance, former Vice President Harris, one of her provisions would have been increasing capital gains rates. So in 2024, I had a lot of clients that if they were looking to sell, they wanted to sell prior to the end of 2024 because their concern was they'd be paying a lot more tax in the next year. So there was a big push by sellers on buyers to make sure that the transaction would happen. Now that we know that President Trump has been elected, he said that he's going to extend the Tax Cuts and Jobs Act. That being said, if there's full extension, we're looking at, I think, another $10 trillion of national debt. So at the end of the day, what we'll see is as good as your guess as mine. I try to look into my magic crystal ball sometimes to figure out what will end up happening, but the answers really aren't there. keep in mind the Ways and Means Committee and the Senate Finance Committee are vastly different than the members that made up those committees back in 2017 when the Tax Cuts and Jobs Act was originally proposed and enacted. There's focus now on the fact that our national debt is humongous and increasing that. So, like I said, at the end of the day, your guess is as good as mine as what we'll see. Potential tariffs. So doing business abroad might not necessarily be as attractive as it once was. We did see that as part of the Tax Cuts and Jobs Act as well. I mean, there is a push to bring manufacturing back to the U.S. One of the proposals is a corporate tax rate. Right now it's 21% for C corporations. The proposal by President Trump was to reduce that to 20% and provide incentive for companies that manufacture in the U.S. to have a 15% reduced rate. So hopefully we'll see a lot this year, and we'll be scrambling to try and keep up and get those white papers out to you so that you know what to tell your clients.
Yeah, I think we were having that same, seeing those same things at KeyBank, right? Especially on the estate and gift tax side, right? With the cliff coming, as they called it. And a lot of clients, once the election happened, basically said that, they did not want to, continue with the state tax planning. But like you said, there's still so much uncertainty out there. So, continuing with that type of planning probably is a good idea. Scott, any comments?
Yeah, so continuing on essentially the same train of thought, the Tax Cuts and Jobs Act, when that came out in 2017, I don't know if anyone was following as closely as maybe we were, what came out in the news was very, very different than what actually came out in the law. And even from what came out from the House was very, very different than what had passed in the Senate and ultimately was signed into law. So be very, very careful in structuring anything going forward based on proposals that you hear. But based on where we stand right now, if nothing changes, the Tax Cuts and Jobs Act expires. But on top of that, even with just a blanket extension, there's a number of provisions in the Tax Cuts and Jobs Act that are still sunsetting that would affect businesses, particularly a further phase down in bonus depreciation, and there is a significant cut in the ability to write off interest. So a lot of deals, I'm sure anyone in this room is familiar with, a lot of deals are structured essentially as a leveraged buyout, essentially. The business will borrow a significant amount of money and use that money to pay off the selling shareholders or the selling members, and then fund or pay down that debt through operations. And as part of the Tax Cuts and Jobs Act from 2017, over the last couple of years, the ability to deduct that interest has been limited, and actually, as of right now, significantly limited to where only 30% of essentially an EBIT number is deductible. So the ability of a company to deduct interest to fund a buyout of a deal is significantly curtailed going forward, and that makes these deals significantly more expensive. So we are seeing proposals right now. I believe I saw an article this morning on this actually, where there's a House proposal to reverse some of the Tax Cuts and Jobs Act phase out and go back to an EBITDA, but there is no going back to 2017 pre-Tax Cuts and Jobs Act where you can outright deduct your business interest. So we are seeing significant changes there, and then there's also a real risk of President Trump and his administration have a new target, essentially. Everyone's been trying to close the carried interest loophole. I don't know, you all have heard this in the news. Most people that don't do tax don't understand what carried interest is. And actually the article I read said close the carried interest tax deduction loophole, except that it's not a deduction. It's a favorable tax rate on the way that carried interest is treated. And essentially what it is it's a incentive profits interest grant to a partnership unit that almost all businesses use. And if there is a real blanket change to this policy, this could really affect how businesses retain key employees after a deal, or even retain employees up to a deal. And these incentive equity structures are huge for your businesses. So I guess stay tuned on what happens with this.
And I think that's a great nuance to really, pinpoint, right? And then also to pinpoint that, some of these provisions are going to sunset regardless if nothing happens. And so people really need to think about, those things as well. Thank you. So John, on that regulatory theme, how can businesses adapt their tax and financial strategies to align with current regulatory trends?
Well, so this question is good because if you've got existing regulatory trends, I think that's the easiest way. I
Right.
mean, if you can predict kind of, you have to know what are the rules today. You go through your planning and analysis and you look at different alternatives and options and stay flexible in terms of how things might come out. I think, companies, when they're looking at a merger or acquisition versus a divestiture, obviously we're talking about different things. If you're acquiring a company, the tendency is to think everything's going to be honky-dory and you're going to get all kinds of efficiencies and you're going to get all kinds of growth. But you also better be planning for the alternative, which is maybe you don't quite realize all that. So again, I think it's more difficult when the sands are shifting beneath your feet, or if there are things that are coming down the pike that are going to change. But in existing, don't read in what isn't there. But at the same time, you've got to look at the full analysis of what options and what alternatives can happen.
Yeah, but how should clients deal with sort of the uncertainty? Because I think that's some of the things that, Scott and Kristen talked about, right? I mean, that's hard. I mean, it sort of drives them crazy, which then drives us crazy.
And that's where more financial planning and analysis needs to happen.
Right.
You need to look at, again, how can things go? What are the things that might happen? And what does that do to my deal? So it's keeping your ear to the pavement, if you will, as to what are the things that might come down the pike, and enlisting the services of the folks that are going to be able to help you do that, like Scott and Kristen.
Exactly. Having a team, definitely. So continuing with that tax policy theme, Pami, so how do evolving tax laws influence deal structures such as stock versus asset purchases?
What I'm seeing at the moment is that business owners are uncertain as to how to pursue their affairs because of the changing climate from the tax side of things. By way of example, a deal I'm currently working on, the buyer wanted to know what are my options: C Corp, partnership, S Corp, and in the discussions, I had to point out that a lot of the Jobs Act provisions are expiring, and we don't know where rates are going to be. And so, while a partnership used to be the preferred vehicle, when I started my career, no closely held business wanted to be a C Corp because the double tax was so expensive. The top rate was 39.6%. Then you have a dividend rate that was what at the time maybe was 25%. I can't remember. Now it's 15%. When you're looking at the current tax rates, it's 21% for a C Corp, 15% for the dividend. That's 36%. When you're looking at a flow through, it's about 29.6% if you take that qualified income deduction into account. But if you have the ordinary income tax rates come right back up, there's literally no tax delta between a partnership and a C Corp. But your compliance costs are much higher with a partnership. You have to track, and if it's a multi-state business, you've got all kinds of issues with flow-through entities at the state level that you don't want to mess with. So I'm finding, surprisingly, that because the C Corp seems to be a bit more settled, more and more business owners are opting for operating their businesses in a C Corp. So hopefully the tax rates on C Corps won't go back up to the nightmare levels they used to be. That way, you have predictability, and it's hard to exit a C Corp. So once you're in it, you're stuck with it, and hopefully the tax rates will be more predictable going forward.
Scott, any opinion on that?
Yeah, so I actually think that following right up on that, being a partnership person, I tell everyone to go into partnership because you can easily go in and out of a partnership without question. it's very, very difficult to go out of a corporation. It's very, very expensive. But once you go into a partnership, you can always exit to a corporation. So if your deal structure is such that you want to go public, go an IPO, something like that, you can always convert into a C corporation or go into an Up-C structure or something along those lines easily enough in a partnership structure, with the added benefit of an Up-C structure where you can defer the tax. But once you go to a corp, you're stuck in there. And actually, some deals we've seen a premium being placed, or at least a penalty being placed on corporations and the value. But I disagree slightly with what you said about tax rates, because I completely agree with you on the federal tax rate, that it ends up being a little bit more favorable. But when you add the double-tiered state taxes, it becomes extremely expensive to be in a corporation on an ongoing basis. And so I still think that it's going to end up being cheaper in a partnership going forward. And I think state taxes is probably where we are seeing the real deciding factor on how you structure a deal, whether on a stock purchase versus an asset purchase, particularly now with the PTET type of tax deductions. I know in Pennsylvania we don't have one here, but in New Jersey, New York, for example, you have your PTET deductions.
And PTET.
Pass-through entity tax
thank
deductions.
you.
These are I use this term every day.
I know,
and
that's
I'm so
why
familiar with it.
I know. Acronyms.
But these are the state
Lawyers and
tax,
CPAs,
the state tax parity type deductions that were, or the workarounds to get around the $10,000 state and local tax deduction cap for pass-through entities only.
The SALT deduction, if you guys have heard that before.
So what we see is a lot of the deal structures really hinge on state taxes, and whether or not the owners live in a state tax or in a state with state taxes, or they live in a state with no state taxes. So if you live if you have a Florida or Texas residence, you're going to be selling stock. If you have a New Jersey, New York resident, you are happy enough to sell the assets, because then you can actually take the pass-through entity tax deduction, get a huge federal benefit, and it really makes a big difference.
No, that is definitely great. So let's pivot toward sort of the conversation we always have, right, when we're looking at deals, due diligence. So Pami, can you explain the importance of due diligence in identifying tax liabilities during a transaction?
Well, that's key to any deal, because you don't want. I've handled buyer side deals most of my career, but there are many ways of doing your due diligence. You've got your tax reps and warranties in the agreement. That's a form of due diligence. Basically, your seller has to tell you what their tax liabilities are, whether they have filed their tax returns, whether there are any open audits, whether they have any other type of exposure. They have to disclose that in a disclosure schedule. So that's the beginning point of your due diligence. But there are many other ways of confirming whether this seller has any tax liabilities. You have to do a search, a lien search, make sure the assets are free and clear. And I do a lot of asset deals. It makes it easier. You have to do a successor liability analysis involving a tax clearance certificate that you might be able to get at the state level. Other than that, you have your indemnity. Basically, no asset purchase agreement I've ever seen says the seller will be, the buyer will be assuming the tax liability of the seller. It's cut off. Same thing with stock purchases. Pre-closing liabilities are excluded. You have to make sure that your indemnities are going to hold up. And one of the things that I have seen in terms of the change between working with large caps versus middle market and smaller companies is that you don't know whether you're going to ever collect on your indemnities unless you make some adjustments to your approach. So maybe you do a holdback of some of the purchase price. Maybe you put it in escrow. Maybe you have the selling shareholders continue on during a transition period, and you can have an earnout from which you can withhold if in case there's something blows up and you get hit with seller's liabilities. But without taking those kinds of steps, an indemnity provision, regardless of how well it's written, you're not going to see your money if you get hit with a major tax liability. I do also have to mention that you have to focus on contractual liability as well. Anything that the seller has agreed to assume from a different party could potentially end up in an asset, in a stock purchase. You would have that, maybe tax allocation or tax sharing agreements. In an asset purchase, you have to assume the liability specifically, which is a much easier way to cut them off.
Kristen, I'm sure that you have some comments on due diligence as well.
Yeah, so it's definitely important to have a team, a good accounting firm to be reviewing the seller side, because especially if you're a buyer and you're looking to purchase maybe a smaller or mid-level seller, you're going to find that most of what they're doing from a tax perspective is probably not correct. Most times, a lot of my clients aren't following GAAP, which is fine, but you want to make sure that in your agreement, if it's talking about them making reps to GAAP, or you're computing an earnout, or a closing day balance sheet, and it's going to be GAAP, well, that's going to be very different from the numbers that the seller originally gave the buyer, because certain things are treated differently for GAAP purposes than they are under just kind of sound accounting principles. It's also important, depending on what type of entity the seller has, that you make sure that they've done proper elections. So we've talked a lot about corporations and partnerships, but if your seller is an S corporation, there's a specific election that they have to file with the IRS to elect to be treated as an S corp, and in certain states, there are state elections as well. So you need to make sure that your seller has done that properly, because if they haven't, then it's a potential that they're actually a C corporation, but they've been filing as an S. Also, they could be doing things that would potentially terminate their S election. So there are very strict rules when you are an S corporation that you have to follow, and if you're not doing that, then, for instance, you have to make distributions based on the shareholders' proportionate ownership of shares. And a lot of times we find that our clients necessarily aren't doing that by paying their own personal expenses through the corporation. And the IRS views that as if they're getting a preferred distribution. So you just want to make sure that you're looking at everything closely, that your sellers are doing things properly, that they're filing tax returns correctly, as well as state tax returns, because in the changing world, especially with internet sales, you have sellers who are encroaching into different states and not realizing that now they have a taxable presence in that state, and maybe they haven't filed. And just to give an experience that I had recently, I was representing some sellers who were a C corporation, and they, instead of taking distributions at the end of the year because they didn't want to have that 2 layers of tax, what they would do is, at the end of each year, they would pay a bonus to themselves. And every year the bonus would be different depending on what the company made. And our buyer, in this instance, looked at that and said, well, actually, these could potentially be reclassed by the IRS as disguised distributions. And so to piggyback, what was said about having an indemnification escrow, our buyer in this case wanted to have a separate tax indemnification escrow, because the concern was they were buying stock of these 2 entities, and if the IRS came in and said they were distributions, that all of these bonuses that the corporations took as a deduction were improperly taken at the end of the day. So we came up with a computation and a separate number, which we negotiated, and that money, will sit until the statute of limitations runs out for those tax returns. So it's really important just to make sure that they're filing correctly, that they're not doing anything, because a lot of small business owners don't realize that they shouldn't be paying for their daughter's wedding through the company. Right. And I will tell you, I had a client who did that. So just be careful if you're looking to purchase a company.
I think that goes into exactly what we were talking about, especially in the beginning, about closely held business owners where they're looking at their business and their family and their personal together. I mean, to them, it is one entity, right? And they're really not looking at sort of the classifications and all of those things. They're like, oh, there's some money over here, let's use that, right? And so I think that sort of pivots us into sort of the financial planning, conversation. So what role, John, does proactive financial planning play in achieving favorable tax outcomes in M&A?
Okay, I'm going to start you with a generic, which is, and my children can tell you this, my children's spouses unfortunately can tell you this, and I have probably quoted this more than the guy who invented the phrase, but if you fail to plan, then you're planning to fail.
Indeed.
And I've said it more than Ben Franklin, who's the guy who originally coined it, and my kids just cringe and whatever, but it applies to all kinds of parts of life.
Right.
When we're talking about financial planning for a deal like this, some of the things that you just mentioned, I look at the CFO and the finance team's role as being kind of the ones that are ferreting out all the information, because I don't have the knowledge that the tax guys do relative to what some of the impact could be on these transactions. So your role is to make sure that you've got full visibility towards everything that's being done and how that could change the deal and how that could impact the terms of the deal. The other thing is, generally speaking, you probably don't have a really good audit trail. Because, a lot of these companies are not really being audited; they might be reviewed, and so therefore, the level is going to have to step up when you talk about getting into a situation where there's going to be a change of ownership. And so, usually people are then liking to do at least a review, if not an audit, and it depends upon the terms, and that also gives different levels of comfort to the buyer in the situation.
And so how early should people engage your tax advisor?
As early as you have the facts. And seriously, I don't think there's
start with the end in mind.
Yeah, if the deal is on the table, then you should be engaging, and then it's incumbent on those folks not to spend more time than they need to until they need to. But you want to identify the team early, and you want to identify what the roles are of the different team members, and it's legal as well as tax as well as accounting.
Scott, any points on that?
Yeah, I agree that you really should be calling all parts of the team, particularly tax, early, even before you have the deal in the cards. Even it doesn't have to be a lot of hours. It could just be an on-call relationship.
Like before an LOI, before anything.
Particularly before an LOI. We've had deals where we're working on a restructuring right now where the client wants to go to market, and they have these phantom equity units that they want to restructure back into essentially a equity unit instead of paying a bonus structure to get capital gains on the sale. And so you can't do that at the deal. You have to plan a year ahead of time to get long-term capital gain treatment. So, if you're thinking about going to market, you really should have discussions with the tax teams to figure out how to go. And really, when the tax attorneys definitely should be involved, but I think the accounting team is a particularly valuable resource, and I say this self-serving, of course. But a colleague of mine used to say that that the accounting firm is where the rubber hits the road. The attorneys understand the theory that the accounting firm puts the numbers down on the paper, and they understand actually how everything has to work at the end of the day, and it adds an extra level of insight that I think that modeling out a transaction before it happens really helps to prevent a little bit of uncertainty and a little bit of confusion once you start getting into negotiations.
Definitely. And so I think it may have been you, Kristen, mentioned that we are in a situation, even though there may be some tariffs coming, we still have to think about the global economy, right? So are there particular industries or transaction types where tax planning becomes especially critical with cross-border planning?
So, honestly, in any type of cross-border planning, tax is key. Because obviously the US tax rules are vastly different than other countries. So it's important to understand the type of structure. If you're looking to purchase a company that is engaging abroad, what kind of structure can you set up from a US perspective that is also going to work from that foreign country perspective? Because we've talked a lot about flow-through entities here and corporations. There are different rules in different countries. There are certain types of entities that if you set up that way, you cannot change your tax classification for US purposes. They're called per se corporations. So it's important to know the difference. Also, if you're looking to engage in any type of manufacturing or any situation where you're going to have potentially one of your entities selling to another entity and then selling, to customers within that local country, you have to really consider transfer pricing, because you can't just decide what the price is that your entities are going to sell between each other, because now the IRS says you have related party transactions, and it has to be as if it was arm's length. So whatever you're charging has to be the same as if you went and bought it from another unrelated party within that country. And what happens is if you don't set those markups correctly, if you don't have a transfer pricing study, the IRS will come in and say, no, you should have had more income in the US, or you should have had more income in that foreign country. And that was a way back in the day that people tried to shift income into low tax jurisdictions. And so that really does not work anymore. And also, thinking about IP, originally, a few years ago, before the Tax Cuts and Jobs Act, a lot of companies wanted to put their IP in a low tax jurisdiction. That way they could then, do a royalty agreement and a use agreement with their other entities for use of that IP. That isn't attractive anymore. So under the Tax Cuts and Jobs Act, we now have GILTI, which is known as global, intangible, low taxable income. And really the purpose of it was to target all these companies that put their IP in a low tax jurisdiction, to make sure that at the end of the day that they're paying enough tax in the US on that income that the entity is receiving. And like Scott mentioned earlier, that when the Tax Cuts and Jobs Act was passed, and it was put together pretty quickly, and because of that, this provision targets not just people who have their IP in a foreign country, it targets basically any type of income that you have in a foreign corporation. So what generally happens is when you have a foreign corp, you're not taxed on that foreign corp's earnings unless they're repatriated to the US. However, if you're a US shareholder of that foreign corporation, in certain instances, you are deemed to have received a distribution. So if you have subpart F income, which is passive income, when you have dividends, rents, royalties, you have a deemed inclusion in the US for that type of income. Mm-hmm. And then if you now have GILTI income, which has become a kind of catch-all, you also now have a deemed inclusion as well. So it's very important to know the tax rates of the countries that you're going to be doing business in, whether at the end of the day, are you going to be paying just as much tax in the US? Is there really a business purpose for engaging in activity in that country? I have a lot of people who come to me who say, oh, I've heard that I should form an entity in this country so that I can save tax. And I say to them, okay, why? Like, what's your purpose?
And this is why you need a tax advisor before you start to do these things.
Exactly. So, at the end of the day, it's just a matter of knowing what are you trying to do, what's your business purpose, and making sure, I cannot stress enough, that you have local counsel in whatever country that you're looking to, engage business in, because those rules are going to be very different than the rules in the U.S.
Indeed, indeed. So, Pami, what tax complexities should CEOs and deal makers consider when engaging in cross-border and M&A transactions?
I think Kristen covered the U.S. side of the equation very well. The Jobs Act really changed the way that internationally earned revenue is taxed in the U.S. But there are two sides to every cross-border transaction, at least two sides, if not more. It depends on where people are located, where the company you're trying to acquire is located, whether you have the system is developed enough for you to be able to do adequate due diligence, the effectiveness of the tax administrators in those countries. And then you have to think about deal structure. Do you want to do a stock deal? Do you want to do an asset deal? Do you want to do a stock deal that is treated as an asset deal? Because from the US tax perspective, a buyer can make an election to make it an asset deal for tax purposes. Much of what we deal with in tax is really, we're looking for that rate delta. What is the lower tax rate? And we're also looking for faster depreciation of things. So we're looking for opportunities where if we can get the purchase price of whatever we're paying for, so if you're paying for shares, and normally, that's capital gain in the US, but if you want to layer that on and get depreciation on the assets, then you're going to have to make an election and treat those as an asset deal. That could trigger, if it's a US taxpayer on the other side, recapture, what we call recapture income, which is if you've taken a lot of depreciation, and these days there's a lot of depreciation because of the bonus depreciation rules. So over time, over the last 20 years, that is one of the biggest changes I've seen, where a seller could potentially be looking at a substantial amount of ordinary income as a result of having taken bonus depreciation of a significant amount, and then that is recaptured when you sell the assets. So they might want a stock deal. I don't want to deal with that ordinary income burden. There are other things to consider in the international tax context, which is the withholding tax regime. So if you've got interest, dividends, royalties, whatnot, services, every country has some kind of withholding regime, and you've got to deal with the tax treaties. So you've got local law that deals with certain things, and then on top of that, you have treaties that you have to consider. And in the U.S., we've got the U.S. treaty system is extremely well developed, but the Internal Revenue Code and the treaties run in parallel. So you've got to figure out whether you want to rely on the local law, the IRC, or take a treaty-based position. For that, you have to file a return to claim that. One other thing I want to point out from the international tax perspective that I think is critical is going back to indemnities. Whenever you have an indemnification obligation from the seller, the ability to enforce that in a foreign court is going to be really daunting. So if you can pull them into a US court, like New York has a very liberal personal jurisdiction regime. So if you want to pull them into New York because they have maybe some minimal contact here, that might work better than trying to get enforcement in a foreign jurisdiction, or trying to get an enforcement in the US of a foreign court's judgment, because there's no agreement between the US and other countries to enforce each other's court judgments. So you're not going to be able to get that foreign court's judgment enforced here. But you can go to court here and try to maybe levy or have any assets in the U.S. seized if you're owed money and you're not getting paid. So these are some of the things that, from the practical perspective, when you're dealing with foreign sellers, you have to deal with. When you have incoming investors into the U.S., normally we just set up a blocker. A C Corp really works well for avoiding effectively connected income in the US, so they don't have to file a return because they're conducting business activity in the US. They can just get their earnings via dividends. Those dividends are withheld at source, which basically means that whoever is paying them has an obligation to withhold the tax, and then they don't have to file a tax return if they don't want to. The withholding satisfies their tax liability.
Well, thank you so much for bringing up courts. Because I think that's something that we all think about a lot. And I think it goes to one of our next questions. What common mistakes do companies make regarding tax and financial planning in M&A, and how can they avoid them? And I'll start with Scott with that one.
I think the most significant mistake that happens is missed elections. What happens And usually these are elections, like in a Section 83B election. I'm sure a lot of people may have heard before, but it's an election that is to include property at the time of grant into income. Usually these are for things like incentive equity. But what a lot of people seem to miss is that if you are converting an unrestricted unit to a restricted unit, even though you owned the unrestricted unit before, it triggers this change. And as long as it's tied to income, you still need to make this 83B election. And if that's not made within 30 days of that grant or that change, you lose the chance. Right. And so when that restriction lapses later, it converts what would otherwise been a capital gain property to ordinary income. So missed elections there, missed elections with Code Section 754. If anyone's familiar with that, it's a partnership-specific section, which is really crucial in partnership transactions so that buyers get a step up in basis on their assets. So when buyers buy at a part of the company, when they're buying equity in a company and not assets in a company, there is a mechanism in the partnership law that allows them to step up the basis of assets to be able to appreciate that. And if that election is missed, absent relief provisions through the IRS, it's gone. And you can't appreciate that asset. And that is a huge mistake that truthfully is caused by inexperienced tax preparers. So people that really don't know what they're doing file these tax returns because businesses want to have the cheapest person available, or their old provider, and they don't know how to handle these deals, so they're missed. But one thing that I think is really less tax and more partnership agreement focused. I know, Palmer, you do this a lot. What a lot of people in these M&A transactions, what happens is that they don't truly understand the economics of their deal. And the waterfall calculations just don't make sense to them. Or when it's run through, they don't actually run the math and do the numbers. And like things like Code Section 704C, which I could speak for 3 days on, but I'm not going to because
thank you.
You'd all fall asleep. But there are certain code sections that force essentially phantom income on people, and a lot of sellers, particularly, aren't expecting that. And so, if these things aren't brought up early in the deal, they can cause really unintended consequences. And a lot of this is due to not having the tax people, the attorneys, and the accountants on the team early.
Experienced ones, like you said.
Correct.
Yeah. John, do you have any thoughts on the financial planning side?
Yeah, I think part of the issue sometimes is that you have high-level assumptions and assertions when you go into a deal, and you need to be able to be flexible because things can come up and it can change the economics, and you need to be able to model out what the impact is of those changes. If you just kind of follow the original script, you can find yourself going down a rabbit hole that you didn't expect to happen.
Yeah, I like that in the sense of following the original script. I mean, you definitely have to plan and pivot, right, and be able to do that. So let's talk about some emerging trends, right? We all are sort of in the digital asset age and the age of ESG. Kristen, how are emerging trends like digital assets or ESG-focused deals impacting tax and financial planning?
So I can't speak to digital assets because I honestly have not had a deal that has involved digital assets since they've came about. But when it comes to ESGs, which are environmental, social, governance considerations, I will say that they're changing the tax impact on business decision making. I mean, there has been a push on businesses for more transparency. Especially we see that among the European Union countries. I would say that probably the next younger generation is very concerned about the environment and our carbon footprint. In the U.S., we had the Inflation Reduction Act of 2022, which was the U.S.'s biggest investment in clean energy. What the bill provided for was over $370 billion in tax spending and tax credits for businesses to provide basically cleaner energy. And not just for energy-related industries, but also manufacturing, industrial, aviation, construction, real estate. And these incentives, are credits that for the first time we saw that were flexible, they were transferable. So now you have maybe a company who, just generally has no taxable income or very low taxable income, and they're already maybe doing some of these incentives to earn these credits. They don't need them. So now there's a market. They can go to the market and they can sell their credits to other businesses. It also then provides incentives for businesses to earn these credits, to maybe engage in these types of, policies in order to then earn the credits and reduce their overall tax burden. And it sure looks good to their shareholders in doing that as well. So, not only are we seeing, businesses wanting to do this, but now we're seeing an additional, business market.
Thanks for sharing that. Anyone else have any thoughts on any sort of unique assets in financial planning? No? Okay, sounds good. All right, next. So let's talk about, maybe we can talk about some specific examples of a deal where strategic planning made a significant difference in the outcome. Scott, maybe you can share something about that with us.
Sure. I mean, I've had a ton I could talk about, but I'll try to pick some of the more interesting ones. One I could talk about, which is a little more, I guess, a little esoteric at this point, but it covered a deal that was a physician practice. So it was in the early stages of when private equity was really starting to expand into physician practices. And it was a long-standing practice that the private equity group wanted to buy into. And what came out during the deal is that this practice existed since the 70s. And anyone who is familiar with old tax law may have heard of the anti-churning rules. And a lot of the newer practitioners actually have no idea what that is. It covers goodwill that existed prior to 1993, I believe. And so companies that existed prior to 1993, if you have a buyer come in and buy a certain amount where there's a rollover interest that creates essentially a related party transaction, the goodwill that was purchased and stepped up becomes non-amortizable under the anti-churning rules, and that's something that the private equity group would not want to do. And so essentially we had to restructure the entire business before the deal to allow essentially drop down the entire company into a separate partnership and have the private equity company buy that partnership interest directly, because there is an exception under, I said it before, Code Section 754 in the 743 transaction, 743, that allows the private equity company to then amortize the goodwill. So that is to the seller, it didn't matter. It was the same thing. But for the buyer, I mean, it was a $40 million transaction that they would not have been able to depreciate, which $40 million over 15 years is an enormous amount of tax savings. So just one example of something that doesn't come up very often, but it made a huge difference in the planning. And I can keep going on.
No, that was a really good one. And I think that the point of it too was just sort of the nuances that you're talking about, right? Where if you have a tax advisor who's really not experienced with these things, really won't notice these things, and sometimes they either slow down or can kill a deal as well. So. Well,
and the buyer had no idea.
And the buyer.
And that's the thing. Their buyer's counsel had no idea, and so that was really dangerous. So.
Yeah. Well, thank you for that. I'm sure you got some other nuggets that you can talk to other people about later. And so we're going to be wrapping up, but I think I have sort of a wrap-up question for all of you. Let's start with Pami. We'll start from the back and get to the front. what future tax policy changes should deal makers be preparing for now?
I mean, it's hard to say because the proposals are all over the place. You know, it's. I think we're talking about tax simplification now. There's a real need for taking the complexities down a notch because the compliance costs are just skyrocketing. But what that would look like would be
Lawyers are not going to allow that. What are you talking about?
well, we'll lose a lot of jobs, that's for sure. But the other
Tax Cuts
problem
and
is
Jobs
you've
Act.
got how do you grandfather sort of what's been done already? So I don't think it's a realistic possibility. But if there are ways, one of the more interesting proposals I've seen is to take the incentive aspect of the tax law, because a lot of incentives in some countries, if you've got your investment incentives, it's in an investment code and not the tax code. But the U.S. has a tax code that's both, taxing and investment incentives at the same time. I have heard a proposal, or I've read a proposal about separating those out, and that could be interesting. But we'll see.
Sounds great. John?
Reading the future is not my expertise necessarily, but I think just basic, again, the old plan to fail is failing to plan. You need to have the team, you need to have people involved, you need to be flexible, you need to be able to pivot, and if you can't really, if you know that there are things that are actually potentially going to happen there's a lot of talk about, then you can factor that in. But you can't just think about things that are out of left field. So the best thing you can do is have a good team and plan as early as possible, and also be prepared for the fact that your original deal may not be the final deal.
Yeah. And get with those team members now, because it's going to be too late in September, October. I know we've had this so many times. I've been through so many cliffs, especially with trust and estate planning, that September, October, November, clients are calling, clamoring for attorneys and for CPAs, and they're busy. They don't have any capacity, and everybody's getting mad at me because I can't make someone do something. So we always tell our clients, look, please, let's have the conversations now. Anyway, yes, Kristen.
I'm just going to reiterate what John just said, is making sure that you have the proper team aligned around you, whether you are a buyer or a seller, and making sure that you have that team set up before you even, if you're a seller, before you're looking at a letter of intent. Or if you're a buyer, as you're starting to think about what business you might want to acquire, it's really important to make sure you identify the key individuals that you feel comfortable with at the end of the day. Because those are the people who are going to be advising you. And to make sure that you constantly ask your advisors questions. Don't try and think that, okay, well, I'm business savvy, so I can figure this out on my own, or I don't need to consult my attorney about that. I had a client who wanted to save on legal fees and thought, with his letter of intent, he could agree to something, and it almost cost him $100,000 in tax. So it's really important to make sure that you have the proper individuals around you, and interview them. I have clients who call me that let me know straight up that they are interviewing other attorneys as well, and what kind of value can I add to his team as opposed to someone else. Don't be afraid to ask those questions and to make sure that you're comfortable, because these are the people who are going to hold your hand through the process.
Certainly. Scott?
I mean, I've said it before already today, but there really is no way, and I agree with John. There's no crystal ball, and there's no way of knowing what's being said today is going to change the law. And so the only thing I can recommend is don't stop your deals. Keep making the deals anyway, but just be flexible in doing the deals. So be ready to plan, be ready to adjust and pivot. Like I said, being in a structure that's flexible, being with a team that's flexible, and then having the experts that are constantly staying on top of the law so you can pivot as it goes. But I mean, stay tuned. It's going to change. I couldn't even predict what the end of this year's tax law will look like at this point.
Indeed. So I think this is our question and answer time. And so, does anyone have any questions? Winnie, first one. She raised her hand first. You're next, though.
I get this question a lot from my clients as a business they usually ask me, well, when do I bring on an excellent team? That means the finance, the CPA, the tax specialist, the strategist. At what point in their business growth do they bring them on? Some say that they should think about it when they're at $10 million in revenue, and that's why I would like to ask the panel, from your experience, what level in revenue should they think about bringing on a team like this?
I'm not sure that there's a specific level of revenue that's going to dictate. I think it depends upon industry. It depends upon, is it a specialized company? A $5 million business can be a very profitable business, and a $10 million business can be a very unprofitable business. I think it's more about, are you getting the information that you need to run the business, as well as are you getting the information you need to help you figure out where to invest to grow the business? So if you've got and that's where you get more sophisticated internal resources, and then you can use the advisors kind of when either deals are coming up or where there's a specific need for them. But you really need to have a solid internal team as a first step.
Yeah, and making relationships with us doesn't mean paying us right away either. So just keeping a relationship with us is...
Get your free lunches while you can.
Yeah. Getting the relationships early means that you're ready when a deal does come up. It doesn't necessarily mean that you have to hire us for, general work early or at a certain threshold. You just develop a relationship as early as you think necessary.
And Trey, you have a question? Sure.
Regarding setting up a C Corp versus a partnership, it was a good discussion. Could you maybe comment on how, if your business was qualifying for the QSBS exemption, that might change or affect your opinion on which way to go there, especially with the state issue as well? You mentioned the state tax issues are being the deciding point. Thanks.
So in all of my years of practice, I just had my first client who actually qualified for that. Because generally, again, you don't see C corporations and you don't have buyers that want to buy C corporations at the end of the day. If you're a buyer, you want to buy assets because, as was mentioned, you want to limit
And Kristen, what's QSBS?
So it's a qualified stock purchase, which means that if you are a C corporation, if you acquired your stock after, again, magic number of 1993, and if your stock was original issue, meaning that you put in some type of consideration, investment, and you received stock back, you didn't purchase it from someone else. However, you could have received it as a gift from someone, but it had to have been what's deemed original issue from the corporation. If you fall into those categories, then when you sell your corporation stock, you could qualify for up to 50% of your capital gain exclusion, up to $10 million. If you acquired your stock in 2010, there was a more favorable provision that says you could potentially exclude 100% of your capital gain, up again to the 10 million threshold. So, like I said, first, you don't really see that many C corporations that are formed because a lot of times small business owners want to take advantage of the pass-through world. They want to be an S corporation or they want to be a LLC that's taxed as a partnership because they want to get those benefits. I don't think anyone sets up an entity and says, I'm going to form this entity because I want to take advantage of selling my stock one day, and that advantage. If you can, it's great. I would not base your formation on just that motivation because you would really have to identify a specific buyer. And in this case, my clients had a specific buyer that wanted to buy their stock and already they were, a global industry giant, and they wanted another corporation to fit into their ever expanding, footprint. But that's the first time I've seen it.
Well, so we actually have a significant practice with this. So we have a lot of clients that set up businesses specifically planning for this, actually. And we will convert businesses. It's very difficult to convert an existing business to qualify for QSBS because it has to be an initial issue. You have to contribute property in exchange for the stock. And the business has to qualify as a small business, which is under $50 million of assets at the time of grant. But we do have a lot of our tech practice will have businesses that they all generally go into C Corps because they run losses for years, and then they a lot of times go public. So they will do this qualified small business stock, and it is a massive incentive if you can do it and qualify for the rules, because you can lose qualified small business. A QSBS is qualified small business stock, so you can actually lose your exemption pretty easily, actually, and you have to hold the stock for 5 years. So a lot of businesses only have a 3-year window, and they really want to hold it for 3 years. If you're going to hold it for 3 years, the tax drag of being a C Corp is very, very expensive, and you don't want to do that.
Yeah.
But holding it for 5, you would do that. But there also is an additional incentive. It actually is $10 million, the greater of $10 million, or 10 times your basis. So if you funded it with $10 million, you can get up to $100 million of gain exclusion. So it could be massive, depending on what it is. But again, it's an individual decision depending on your type of business, your potential exit strategy, your timeline, and really what that first 5 years would look like.
And we can give a whole presentation on this too. I mean, it's a really, truly big practice as well. So thank you. So no, that was a great question. So I just want to thank our panelists. Can you all give them a round of applause? I think it's been a great panel. I hope you all enjoyed it as well. I think, having a great team around you and planning in advance are two of the biggest themes that came out of today. So I am Kalima White. I am with KeyBank, and I am going to throw it over to Martha.
Hello. Oh, okay. I didn't know if it was going to work, Kyle.
Okay.
Yeah, so as Kalima said, she's one of the sponsors. You guys, there are a few people sitting around. I know that her colleagues are here.
Yes. And so my colleague right here, Chris Smith, with our commercial team as well. And we have a couple of my colleagues here in the back, and we have a lovely booth there as well. So thank you very much.
So we're going to give you guys a few minutes to network, and I know the food is smelled, but before we do that, I forgot to give my company a plug, which I think I was supposed to have minutes earlier. And then I also want to bring up another one of our platinum sponsors. So we all get involved with these. We love your panels, and you do need to have your team. But I think a lot of us in this room are service providers, right? I'm an insurance broker, and that can often, we get into a room, we're like, ooh, who do we go to, right? And you want to look for the immediate benefit. But I think in this room, we really want to understand what each other do, how we can help each other, how we can support each other with our networks, and give our clients the best team. So understanding my role at Hub is I can quarterback to any type of insurance. I work with larger commercial insurance. We work on M&A transactions. We could do professional lines up on the portfolio level of a PE firm or service providers. If you're looking for your E&O or D&O, we can insure transactions. Some of those larger transactions, probably 15 million or up, are getting that reps and warranties. And we can do traditional commercial insurance, right? I can do your property, your casualty, your benefits. And if I'm not the right girl for you, I'll find a good insurance broker. We have some great people here that focus on real estate or smaller accounts. So I really do invest time in understanding that. Hub can usually do it. I can usually find it. But if not, I'll be honest with you and find the right person. So I encourage everybody to understand. I'm going to bring up Mary, and I know all of us know a little bit about SBA lending, but it's important to understand who you're working with, right? I actually owned a business and had an SBA loan, and it was a nightmare. I didn't have a good team, and I fell on my face, and it was really, really difficult. So if you could have somebody in your network to give an introduction to small business owners, it's a difficult thing to do. So Mary, if you want to come up, I don't want to talk about your business. Tell them kind of what
Mary,
you do.
I'm going to give you the mic.
Oh,
I'm going to sit my seat with me. So there you go.
there you go.
Yeah.
Thanks, Mary.
And of course, I'm losing my voice, so hopefully you guys can hear me okay. Mary Soldano with Truliant Federal credit union. I've been in SBA a little under 10 years now, mostly specializing in mergers and acquisitions for the last 5 years. And so we have my colleague Shem is here, and also Emily is running around somewhere too. Shem is a fellow BDO too, so if you trust me with your deal, you also trust him. He's the best. And so, yeah, we specialize in SBA 7A. We all came on board this past April to True Lion. They're a federal credit union based out of North Carolina. This is going to be a really hard panel to talk on with this voice. And so since joining them, we ranked up to the #1 credit union in the country. Our team has been together for a little under 5 years at 2 different shops. And so Ray Drew, our managing director, brought us here in April, and we just hit the ground running. And we're building something really special. And so, yeah, SBA, I think it's one of the best tools if you are looking for your max would be $5 million financing for SBA 7A. And there's a lot of flexibility, especially recently, which we'll talk about during the panel, with structuring, seller financing, seller rollover equity, a lot of cool things to be able to get the job done and get both the seller and the buyer what they need at the end of the day to close the deal. So we'll talk later.
I love that. It's all about working with people that you vibe with and having more than one person in your network because your client might not vibe with everybody. So we're going to give you guys a chance to network. We're going to call you back in when you hear Winnie's voice. She's going to call you back in for another panel in a little while, but grab some food, talk to people, ask what they do, and listen, and hopefully you leave here with another person for your network.